look at the share market and what's happening, like pre-COVID-19, what was the landscape, and then what is it now?
So I think people get caught up in talking about the stock market was expensive. The stock market wasn't expensive. The stock market's never expensive. It's the companies that make it up may on average be more expensive than they were. But there are certainly companies that were cheap in February, and they're a lot cheaper now. And there were companies that were looking really expensive in February, and they're looking a lot less expensive now. The landscape certainly before COVID-19 was that rates stay lower for longer and earnings keep trickling along higher. It wasn't that earnings growth was going wild, but there were certainly some bright spots. Things like technology were doing really well, and healthcare was doing really well. And to be honest, nothing's actually changed. Those same businesses that were outperforming then are outperforming now, but they're just doing it at a lower level. So markets have all kind of re-rated lower, but even in the last 20 days, we've seen stocks kind of re-rate. Stuff like Amazon's at all-time highs. So it really is a horses for courses. You've got to talk about specifics. Yep. And I think half the problem is people like to talk about this general stock market that doesn't really exist.
So similar for a lot of our listeners that are property investors, similar when they say, the market's up or the market's down, it really depends on commercial versus residential, city versus city. And there's just so many other nuances, and the share market would be, even more complex again.
It's not more complex, to be honest. It's exactly the same. So, it doesn't really matter what the stock market does. If you own a great company and the company keeps growing every year, and it's the same as you own a great corner block with development potential and you're renting it out above market yield, well, that's a good investment. That's what you're experiencing. Your experience as an individual is that investment. So who cares what the market is doing? It doesn't actually really matter.
Gotcha. Okay. And so for those out there that are thinking, now's the time to jump in and you should be buying these blue chip shares that are 30 or 40% cheaper than they were maybe a little while ago, what's your general advice to someone, and keeping in context here that we are not coming across as financial advisors, or this conversation is simply a conversation.
Yeah, a bit of general advice warning. We haven't considered your personal circumstances.
Correct.
Look, happy to have a general chat. And look, I think the first thing that's really important is you use the word blue chip stocks. Well, what do you actually mean? Do you mean the stocks that you know and you've heard of? If that's what blue chip means to you, well, we better define specifically what those stocks are. I think it's important to think about investing in any growth asset class, whether that's property or shares, as a long-term proposition. So in the first, there's no quick money here. There's no quick buck. And even if you're lucky enough to chance it, do it 100 times and you'll get half right and half wrong. And probably not being a professional, you'll lose more than you make. So I don't think that people should be thinking about blue chip stocks or lack of blue chip stocks, or stocks that, let's find some great businesses to invest in. And as I said, that question, or the answer to that question, really hasn't changed a lot. I mean, there's some structural tailwinds in the global economy, which are persistent, whether there's a virus going around or not. And the companies that are exposed to some of those growth winds are going to do better than others. But I think one thing that people can keep in mind and can take away is that during recessionary times, which is what we're undoubtedly going to experience for the next 6, 12, 24 months, the big companies, the companies with dominant market positions, sustainable competitive advantages, really strong balance sheets, experienced and stable management teams, and loyal customers, big margins in their profit margin, these businesses get bigger and they take more market share off the small guys as the indebted guys go out of business. Businesses with a weak client proposition end up losing business and losing market share. They're either acquired by the large guys. If they're a good business that's a potential competitor down the track, they use a low valuation to do that. Or even just the cost of capital advantage. If you're a big company, you can borrow and raise money at a cheaper price than somebody who's a smaller competitor. So that just gives you a huge advantage in terms of making investments today that may over the next 5 or 10 years result in a hockey stick acceleration in your earnings. So these are the kind of businesses that we're trying to invest in at the moment for clients, and the kind of things we're looking at every day when we're in the markets.
So is that a focus on bigger business more so than smaller business then, if you were to look at, just a general?
Yeah, I think for the average investor, you want to be looking for strength. and you want to be looking for, established businesses. We talked about Amazon before. They were 50% of retail in America before. They're going to be 60 or 70, over the next 10 years. It's not going to change there. If we think about a company like Adobe Systems, who make, Photoshop and Illustrator and all of the Adobe Creative Suite, Adobe Reader, that's a dominant product that everybody uses that's not going to change. If you've gone to graphic design school and learned how to design on Photoshop and Illustrator, you're not all of a sudden going to change to some new product that comes out, because that's the language that you speak. That's the language of your business. So if Creative Suite put their prices up next year by 10%, you're going to pay.
Then how do you pick something that is like dominant and everyone uses it like a taxi and see that Uber coming in the distance? What kind of things do you look at from a disruption point of view?
I think disruption, is a really interesting concept, and it's got a very popular kind of vibe to it at the moment, and has had for the last couple of years because of the likes of, the Ubers of the world or Airbnb. I think the risk with disruption is that a lot of people see a certain product or a certain thing disrupting some other thing, but often the status quo is maintained. Even looking at Uber, if you'd invested in Uber along the way, you would have made a lot of money, and most investors wouldn't have had the chance to get into that until the IPO. And since the IPO, the stock's been absolutely smashed and hasn't recovered really. So not because of coronavirus, but because the business is unsustainable at the scale that it's at. The other big example of the disruption model was WeWork. That was a business that essentially arbitraged, long-term leases into short-term leases for co-working spaces. But once it got to scale, people realized this business will never be profitable. So things that often look disruptive sometimes aren't. And just because they are disruptive, like in Uber, like I use Uber all the time, doesn't make it a great investment.
So do you think sometimes people, that's very interesting, Luke, do you think sometimes people get excited about this, setting quoted, this disruption business and, tech business, and they read about all this exciting, sexy figures in the papers, and then they think they want to get involved in that and be amongst it, but they really don't understand the fundamentals of it?
100%. I mean, I've seen, and when I'm talking about family offices here, I'm talking people with, 50 or $100 million invested in non-property, for lack of a better word, might be private equity and businesses. I've seen so many family offices torch, $5-10 million investing in the next big insert, whatever here, application business, technology business, disruptor. And, these businesses, especially now, no revenue, huge cash burn rates, chewing through $100,000, $200,000 a quarter, a month sometimes, and, employing all these people. And these businesses just die in periods like this. They don't have access to capital. Nobody wants to invest in them. They don't make any money. Even if they were starting to make some headway, they're going to be, trading at cents on the dollar. So I think really got to be careful around the next big thing, because chances are it's not, because 9 times out of 10, it's not the next best thing. 1 time out of 10, it is. And we hear about that 1 time out of 10. And that sort of selection bias of the media is a really dangerous thing in investing.
What do you think it is that makes people want to control their own decisions around investing, which in my experience, in conversations, most people seem to get it wrong, or they get it so badly wrong they don't tell anyone about it, so you would have known. What do you think it is psychologically that makes people want to set up their own, online com account and start moving money around and buying companies?
Look, we've talked about this, over many beers over the years, mate. But the real answer is people don't understand the mechanism that is the stock market. So, I met you through boxing actually, which is ironically because this is actually the best possible example. You've got to think that, there's millions and millions and billions of people around the world every day looking at shares. There's people like me who spend 10, 12 hours a day, 5 or 6 days a week, just looking at shares because it's my hobby and I love it. And plus I get paid to do it. So, that's all I do. And I employ, the best technology that I can find. I pay the smartest consultants that I can find. I read absolutely everything from everywhere. I've got a connection to every single investment bank, and I get all their research and I read everything. And then go into the market every day and decide that I'm wanting to buy shares in ABC. right? And you're on the other side of the screen. You've got ABC shares and it's gone up 10%. You think I'll take some profit. Well, guess what? You're actually selling to me because I know that stock's worth 80% more than what the current value is, even though you've made a profit at 10%. So I think people forget that the stock market's a zero-sum game. It's adversarial and it's exactly like a boxing fight. I don't care how much training I've done. I'm not getting in the boxing ring with Mike Tyson. And for every time there's a buyer, there's a seller. The share market's not some mystical place where you can put money in and there's no counterparty for that trade. There's always someone on the other side of the ring, and you really want to make sure that you're feeling fairly confident that you know more than they do.
Yeah, that's interesting, mate. And I think a lot of people don't break it down like that. You're right. It just seems like this, almost fictional space where you can kind of, jump online and move money around and watch businesses go up in value. But I mean, everyone works so incredibly hard to make money every week in their craft and their job. And, I think a lot of times investment can be done quite flippantly and without solid, sound professional advice. And, you said it well. I think most of our clients, especially doctors, they are very careful of not getting outside the area of training. They're very, very mindful of that. And then there's a boundary and they refer to specialists and other things. And I think you've touched on that today, mate. You've got to get the specialists around you and make the right decisions.
I think for sure. And I mean, I think even for your business, like I wouldn't even buy a residential property for myself without you sorting it out for me. Like, obviously you're my preferred provider, but that's just, whoever your preferred provider, not necessarily blowing you up so much. But the point is that use a specialist. If you're going to invest, whether it's setting up a business, whether it's, buying a home, making an investment property, these are hundreds of millions of dollars that we're talking, hundreds of thousands of millions of dollars here. And it's so easy just to spend, 10 or 15,000 and have peace of mind that you've got it right.
Yeah, 100%. I think, mate, I appreciate your time. And I think the biggest takeaway for me is it sounds like the fundamentals of what you look at are quite simple and straightforward, but it's time intensive. And you got to know what the baseline is that you're comparing it to. You research one company, that company looks great, but how do you know what you're saying no to by putting your money there? And, I think
opportunity cost, my friend. It's, it's the number one thing.
10% is great, but it's not if you could have got 40% or 50%. That's what it comes back to. But Luke, as always, mate, grateful for your time and thanks for your insights.
Anytime, Jules. Lovely to see you, mate.